Hello learners, in the previous lesson on working capital estimation, we learnt about use of traditional method for estimating working capital. As you know, in the working capital management, first step is the planning for working capital. That means how much amount of working capital is needed to support a particular level of operating activities. So, always we estimate working capital and then we decide from where that working capital has to be financed. So, in the previous lesson we learnt about traditional approach. In that approach, we estimated different components of working capital and you know these were the components of working capital. So, we estimated different current assets like what is the level of raw material inventory, finished goods inventory, semi-finished goods inventory, level of investment in receivables, level of payables and all that, and we arrived at working capital requirement. Now, in today's lesson, we will be focusing on operating cycle approach. As you know, every business, whether it is trading business, that is merchandising business or manufacturing industry, there is something called as operating cycle. That means to say the operating activities flow through a particular cycle, flow through a particular process, and that particular operating cycle generates different kind of current assets and current liabilities. Or this operating cycle approach is also the dynamic approach, because according to operating cycle approach, working capital means requirement of funds to finance different operating activities or routine activities. Now, what is the shape of operating cycle? So, you can see this is the operating cycle of a manufacturing company. That means company is buying the raw material, converting that raw material into finished goods. So, when we convert the raw material into finished goods, so some time gets elapsed in processing the things. Then once the finished goods are ready, these are sold out. Now, look at the fact. If I say with the cash, when you go to buy the raw material, instantly raw material will not come to you. It might take some duration. Let us assume it is taking 5 days to procure the raw material. So, figures which I am writing are the days. It may be months or weeks, anything it can be. So, it takes 5 days to procure the raw material. Then some processing is done, some conversion activity is done, and it takes 3 days to make it semi-finished goods. It means, what is this 5 days? That is raw material holding period. So, there may be many things, many meaning of that, but we simply are interested to know what is the raw material holding period. Now, when it takes 5 days to procure the raw material, definitely what I will do as a purchase manager, as a stores manager, I will keep the stock of raw material equal to 5 days requirement every time with me. So, we say raw material holding period is 5 days. So, interpretation of raw material holding period is that for how many days requirement we keep the stock of raw material in our store, in our warehouse. Then 3 days work in process days. That means to convert that raw material into semi-finished goods, it takes 3 days. So, on an average, my inventory of WIP is equal to 3 days requirement. Then further it might be 7 days. Then we have finished goods holding period. That simply means that equal to how many days of requirement I keep the stock of finished goods in my warehouse. So, let us say it is 15 days finished goods holding period. So, this 10 days was the days to convert it, but I am again holding equal to 15 days raw material, 15 days finished goods before these are sold out. So, on an average I will be holding the inventory equal to 15 days finished goods. So, meaning of inventory holding period is that on an average equal to how many days of inventory we keep in our store, we keep in our warehouse, whether it may be raw material, semi-finished goods or finished goods. Now, once finished goods are there, they are dispatched to the showroom, definitely sales will take place. and if we are selling on credit, receivables will get generated. It means you will not get the cash immediately. They will pay you after few days. So, let us say they pay you after 24 days. So, average debt collection period in this case I have exampled as 24 days. This simply means on an average we collect money from our customers after 24 days once credit sales has taken place. And interpretation is again, implication is again the same, that on an average my investment in receivables is equal to 24 days cost of sales, 24 days cost of sales. And always remember, in working capital estimation we focus on cash cost, that means exclude the depreciation. So, meaning of different holding periods or storage period is that on an average equal to how many days of requirement of inventory I am keeping in my stock, on an average how many days it takes to collect the money from credit customers. However, if sales is done in cash, so money will come in cash to me. So, that is the operating cycle of a manufacturing company. Now, this operating cycle affects requirement of working capital. In general, longer the operating cycle duration, larger will be the requirement of working capital. Shorter the operating cycle, less will be the requirement of operating cycle. Now, in this case, if I ask you to count on the number of days which I have written, so it becomes 15 plus 15, 30 plus 24, 54 days. So, that 54 days is the gross duration of operating cycle. 54 is the duration of gross operating cycle. And why I am saying gross? Reason being, I have not taken into consideration financing from payables, because when we sell on credit, we also get credit from our suppliers. We also make delayed payments. So, in total if I say payables period is 20 days, that means on an average we are making payment to our suppliers as well as for the expenses 20 days after they occur. Then definitely our financing is there for 20 days. So, my net operating cycle will be 54 minus 20, that is 34 days. That means to say on an average one cycle gets completed in 34 days. So, that is the example of operating cycle of a manufacturing company. So, operating cycle means cycle from cash to cash, simple, cycle from cash to cash. Then we have operating cycle of a merchandising company. That means a company which is not engaging in the manufacturing of the goods. It is buying the finished goods, ready goods, packaging it and selling it. Only that much is taking place. And in certain cases, no packaging, extra packaging is required. So, we start with the cash, we buy the raw material, finished goods, we sell it, accounts receivable get generated and collect the cash, cash comes to us. And if by chance sales is in cash, immediately cash will come. So, duration of operating cycle becomes short in this case, in general. So, that will be the operating cycle of a merchandising company. Now, these operating cycles play a critical role in working capital requirement. So, how working capital is estimated given the operating cycle concept? The duration of working capital cycle. So, operating cycle is also known as working capital cycle. Operating cycle is also known as working capital cycle. It is also known as cash conversion cycle, because every operating cycle will start with cash and come back to cash. So, whatever name you call it, net operating cycle which is depicted at this point, net operating cycle is this. So, this is net operating cycle duration, RWFD minus C. And what these things symbol? Raw material storage period. As depicted in the previous slide, if it is 5 days, it means on an average I am keeping stock of raw material for 5 days requirement. Similarly, WIP period, if it is 10 days, on an average my money is blocked equal to 10 days semi finished goods WIP. So, I am keeping stock of semi-finished goods equal to 10 days requirement, so that production process keeps on continue smoothly. Finished goods storage period 15 days or 1 week, 1 month, 2 months. This means on an average I am keeping the stock of finished goods for 15 days requirement or 1 month requirement, whatever is there. Debt collection period 24 days in our example. That means on an average I collect money from credit customers after 24 days from sales, and this also implies that equal to 24 days of total cost of the credit sales is blocked into debtors. So, if your daily cost of credit sales is 1000 rupees and debt collection period is 24, so on an average your investment in debtors will be 24,000. Then credit period available. So, this credit period will be available for payables resulting from credit purchase of raw material as well as delayed payments or outstanding payments. But in general we take it average payables period. That means on an average after how many days we make the payment to our suppliers. So, this is the way net operating cycle is there. So, we have understood the meaning of different holding periods, payables periods and something like that. Now, point comes how this operating cycle concept, how this knowledge of operating cycle can be used for estimating working capital requirement. So, we have logical steps for that. So, these are the steps in working capital estimation under this approach. Step number 1, we are required to calculate different storage period or holding periods. So, formula for these storage period or holding period is given in your accounting books also, in every finance book also. So, how do we calculate different storage period? Meaning I have told you. So, quickly just have a glance at the formula which are given to you in this one. Raw material storage period. Average stock of raw material is divided by average cost of raw material consumed per day. That means simply what you have to do, take the total raw material consumed in a year divided by 365 or 360. Generally 360 is for the convenience purpose, but there are 365 days. You will get raw material storage period, meaning I have told you. WIP period, definitely average stock of WIP. So, every company has opening stock of WIP and closing stock of WIP. So, in all the cases how average is coming? Average is simple, opening plus closing divided by 2. So, if you are talking about average stock of finished goods, so opening stock of finished goods plus closing stock of finished goods divided by 2. So, that is the way we can get every kind of average. An average cost of goods sold per day, that means total cost of goods sold for the year divided by 365, you will get average cost of goods sold per day. Likewise, we calculate all these components, each formula is there with you. Now, if you apply the last part, net operating cycle duration, so add up the first 4 components: raw material storage period, WIP period, finished goods storage period, average debt collection period minus average payables period, you will get duration of net operating cycle. So, first step is calculate duration of net operating cycle by calculating these elements. Now, in an examination, either you will be given the facts to calculate these storage period, or straightway you might be given these holding periods or storage period. So, that is the first step. Second step, calculate number of operating cycles in a year. Now, if I simply depict it, let us say our net operating cycle duration is 70 days. It means one cycle gets completed in 70 days. So, how many cycles will be there in a year? 365 divided by 70. So, somewhere more than 5 cycles. 365 divided by 70 make it 5.21 cycle. 5.21 cycles. Now, simple fundamental to calculate or use this particular number of cycles in a year. So, step number 1, calculate duration of net operating cycle. Step number 2, find out how many such cycles will be there in a duration of 1 year. Then working capital requirement can be estimated like this. Working capital requirement without contingency provision is simply total cost of sales. So, you have to estimate what is going to be my total cost of sales for the year, and remind you it has to be cash cost, which simply means depreciation and amortization has to be excluded, divided by number of operating cycles in a year. So, for example, if I say for the next financial year your company is going to have sales of 2000 crore and total cost for that sales is going to be 1600 crore, and this 1600 crore includes depreciation 100 crore. So, 100 crore is included as depreciation in this 1600 crore. So, what is your total cash cost is 1500 crore. Now, if I simply ask you for next financial year you will operate at the sales level of 2000 crore for which cash cost is 1500 crore. Will your investment in working capital will be 1500 crore? Give a pause and think yes or no. In my opinion, it will not be 1500 crore. Reason being, it will be affected by number of cycles, that is number of net operating cycles. So, here comes the role. 1500 crore divided by, let us assume there are only 5.21 cycles which we calculated few minutes ago. So, 1500 divided by 5.21, we get it 287.91 crore. That means to say your requirement for working capital without contingency is 287.91 crore, not the 1500 crore. Fact is clear. You start your day 1 with 287.91 crore. That 287.91 crore will flow through the whole process, raw material, semi-finished goods, finished goods, and finally at the end of 70 days you will get back this 287.91 crore. You will get back this 287.91 crore, and again the cycle will flow because we are making 5.21 cycles in a year. So, that is your working capital requirement without contingency provision. Now, add the contingency provision. If we say 5% is the contingency provision, so 5% of 287.91 is added as contingency provision. So, that becomes 14.39. So, sum total of that will be your working capital requirement. Sum total of that will be your working capital requirement. So, 302.30. So, that is the way we estimate working capital under operating cycle approach. So, step number 1 was estimation of operating cycle duration, definitely net operating cycle duration. Step number 2, calculate how many net operating cycles will be there in a year. How many net operating cycles will be there in a year. So, this is step number 1, this is step number 2, and this is step number 3. Now, we can quickly see an example. This pro forma has to be filled because ultimately you have to calculate your total cash cost. So, this pro forma you can quickly note down, keep it with you. By making a fill in the blanks in this pro forma, you can calculate total cash cost of the sales. Now, if we take an example. Total cash operating expenses estimated for the next year are, so it is total cash cost are 850 lakhs. Average operating cycle period for different elements are as follows. Now, in this case, first step is already done. We are given all the holding periods. Estimate working capital requirement when provision for contingency is 5%. So, for you, first step has already been done. So, sometimes in examination this kind of question comes. So, first step is done, we have to start with the second step. That means, we have to find out duration of net operating cycle. So, net operating cycle duration will be what? So, we can calculate what is my net operating cycle duration. So, add up these average credit period allowed to customer, raw material period, WIP period and finished goods period, because these are the gross operating cycle which I have encircled. So, if we start in a logical manner, so it will be 125 plus finished goods storage period 90 days plus average credit period to customers 100, then WIP period is also 30. So, add up these four, it will become the duration of gross operating cycle 125 plus 90 plus 100 plus 30. So, gross operating cycle duration is 345, whereas average credit period from suppliers is 70. So, what is my duration of net operating cycle? 275. 275 days. You can see it 125, 30, 90 and 100. So, that makes it 125 plus 30 plus 90 plus 100, 345 minus 70. So, net operating cycle duration is 275. Now, what is my cash cost? 850. So, it is definitely futuristic. Now, we proceed further. So, number of operating cycles in a year, number of net operating cycles in 365 days, 365 divided by 275. So, we get it 365 divided by 275, 1.33 cycles in a year. And what is going to be my cash cost? Cash total cost is equal to 850 crores or lakhs, whatever it may be. Then working capital requirement without contingency provision is equal to 850 divided by number of cycles. So, 850 divided by 1.33, we get it 639.09, and to this we will add contingency provision. So, provision is 639.09 times 5%. So, 5% of that becomes 31.95. So, 639.09 plus 31.95, we get it 671.04. So, that is my working capital requirement. So, it is that simple under operating cycle approach. So, this is the way operating cycle approach can be applied for estimation of working capital. So, in practice, maximum companies, maximum executives use traditional approach in which we estimate each component of working capital. Reason is simple, because we have to exercise control on each component. So, I need to know how much of my investment is there in raw material, semi-finished goods and debtors. However, in this also we can do that because we are given holding period. So, we can calculate separately also, but that will be traditional approach then. So, whenever in an examination you are given situation like this, always do the things like this because it will be mentioned in the examination which approach you have to follow, and accordingly we can work it out. So, this is the way we can estimate working capital requirement. So, that is all in working capital requirement. Keep on revising, keep on practicing. Till then, wish you good luck. Thank you.